An analyst is reading it. Well, Mangesh Bhadang, the research analyst at Nirmal Bang Institutional Equities, joins in. Hi, Mangesh. Morning. Mangesh, what are you making of it? I mean, ACC's numbers are a howler. Sonia was just asking me in the break that how come they delivered margins of only 0.5%. I said, I'm not sure. I went through 14, 15 brokerages and no one ever came out with even anything like 2 or 3% or even 4, 5%. My question to you is, now the street is looking ahead. Costs per ton have gone up. How much of a relief for the industry you expect on a cost per ton basis, say in Q3 and in Q4?
Yeah, good morning, Nigel, and thanks for having me. So when it comes to the cost, I think there should be at least 200 rupees relief in the third quarter, and another 200 to 250 rupees relief in the fourth quarter is what we are currently building in right now. And as you rightly said, the results have been disappointing, and ECC has been definitely being something which is out of whack. We had not expected it for sure.
I think the larger issue, and we were discussing this as well, is that on one hand you have costs going up, on the other hand demand has not come back in a very big way. So how do you approach the space as a whole? Are you cautious, and would it be preferable to stick to large cap cement names versus mid cap? What's the approach at Nirmal Bang?
No, so if you look at demand, demand in the first quarter grew by 17% on a week base. And in second quarter, we are expecting it to be somewhere around 10 to 12%, which is based on basically based on our estimates for the 2Q number. So first half, we would be around 15% growth. And in the second half, we have a very weak base of last year to work with. So I'll not be surprised if actually the industry turns out a very good demand growth number this year, which would be anywhere between 9 to 10%. And next year is probably the pre-election year, wherein generally we see spending going up. We have already seen sharp impact on margins of cement companies this quarter because of weak pricing as well as cost. And then we are getting into a period wherein busy construction season starts, as well as the commodity cost inflation is coming down. So that should help margins, and obviously it's not, recovery will not happen in a quarter or two, but definitely the growth or the path for recovery is definitely there, and we expect that the overall margin recovery should go back to normal by the time we end fourth quarter of this year.
Mangesh, I mean, if you have a year, 2 year kind of view, are these which are the good stocks to buy now? Because you're absolutely right. I mean, pre-election year, usually there is a pickup in infra spending, etc. So with that time frame in mind, which are the best plays here?
So in my opinion, I think Ultratech, if you look at currently, looks really good in the large cap space. We believe that it can easily turn in 10 to 12% volume growth for the next 3 to 4 years. And that should drive its EBITDA. So volume growth would be the key driver. And then you also have this commodity cost coming down. So that should help normalize its margins, which have been weakened temporarily. So Ultratech, and it's trading much below its 10-year as well as 5-year averages on EV/EBITDA multiples. That should ideally be a good choice of the large cap space. And within mid caps, I think we like Eastern region a lot, because we believe that Eastern region demand recovery would be much faster. And Eastern region has had a lot of temporary factors affecting demand last year, which will not be here this time around. So that should be an outlier in my opinion. So Eastern region companies, I think Nuvoco is the one that comes to mind. And barring that, I think JK Lakshmi and Birla Corp are the two names that we like from there.
Okay, all right. Mangesh, some of your picks have come up, but I wanted to probe you further on this ACC Ambuja. There's going to be some savings because royalty goes out of it. I think ballpark it should be around 60 rupees per ton of savings, which normally they were paying it to their parent. But this street is also factoring in other benefits to come out, because of the new parentage. They have some expertise in coal mining, they have a port as well. Have you factored in anything? And if you've not factored in, what could that potential number be on a savings per ton for both these two entities?
Yeah, so Nigel, we have looked at all the cost items of the combined entity, ACC and Ambuja, and we estimate that at least 300 rupees cost saving should be possible for Adani Group. And in fact, large part of that should come from the initiatives that have already been taken by ACC and Ambuja. So they are in the process of adding almost 80 megawatt of WHRS system, waste heat recovery system, which should aid in lowering the power and fuel cost. Those are already started commissioning, and that should give some relief next year. And along with the technical know-how fees going away, the addition of WHRS And then there is addition of another set of renewable power and the coal expertise that Adani can bring in. Altogether can bring in 250 to 300 rupees savings.
So your 300 rupees is factoring in both what the erstwhile promoter did as well as what the Adani Group can do, right?
So actually, we would wait for at least some commentary from the Adani Group to make a further assessment of our estimate. But as you know, we have not heard anything from the new management, and we would probably wait and see once they settle down.
Okay. Finally, what does one do with a name like Shree Cement? I mean, this year has been, a year of wealth destruction for Shree Cement investors. I think at the start of the year, the stock was somewhere around 27,000, and it's now almost, ready to break 20,000. What are your thoughts on whether one should keep buy the dip here in anticipation of any revival, or do you think that just staying away is the best option?
Yeah, so Shree has been a darling of the investors for a pretty long time within cement space, and generally this has been the highest multiple stock in terms of valuations. The valuations have come off recently. That is because the volume growth that you expect from Shree, as well as the capex intensity that they have in terms of adding capacity or adding plants ahead of time, has been missing somewhat. And what we have seen is that the last two capex that the company had done, that had been some delay. But anyway, Shree remains one of the best performing cement company within the industry. And we believe that even though temporarily EBITDA growth is on the lower side, we should see the company bouncing back. And in fact, if you look at most of the other numbers as they come out, you might see that Shree had actually given a really good set of numbers.